All right, ladies and gentlemen, welcome to a live webinar. You're with me, Sri, from Phillip Nova. And today we will be discussing the US indices, the upcoming market events, and potential opportunities in the market for you. So, what will we discuss today? Well, let me set the context first. How will the high inflation rates, high interest rates, and recent market events affect the US, its economy, stock markets, as well as the stock markets? This webinar, we'll hear from professional trader Wong Kon back in the studio with us once again, and he will discuss these key points and more in this upcoming webinar. He will discuss the summary. He'll give a summary of the current market events. He'll tell you, with a strong US dollar, can the US walk out of this global inflationary crisis based on his years of experience as a professional trader? And the US markets and what is its likely direction till 2024. So that you're looking at a 2-year outlook. And till then, what should investors and traders do? About our speaker, if you've been attending our live webinars, he would be no stranger to you. He's none other than Wong Kon. He has more than 25 years of experience in the finance industry. He's an investment strategist and has experience managing his own fund, and he founded Weipedia Private Limited. Both the CME Group and the Singapore Exchange regularly engage him to develop training content and speak at events like this. Kon specializes in the market psychology as an investment strategist. He is also an expert in risk management. Kon is often invited to share his views on the market and provide trading insights with industry practitioners, fund managers, proprietary traders, dealers, and retail investors like you and I. All right, Kon, if you're all set to go, can I request that you have your webcam on so that we can see you? All right, members of the audience, before I hand the reins over to Kon, can I just do a quick sound check? Can you hear me loud and clear? All right, thank you so much for verifying that you can hear me loud and clear. Kon, if you're all set to go, I'll hand the reins over to you now. Kon, please.
All right. First of all, thank you, Sri. It's always good to be back to Phillip Nova. And also thank you for CME for bridging between myself and Phillip Nova to again come back for this session. And I think beginning of November was a hot topic, which is the US midterm election. But I think as time passed, I think not many investors are actually looking at it. But I think it's still good because this topic was given to me. That was about 2 months ago, and everyone was excited. But you could see how the interest have died off along the timeline. But it's still good to discuss about something about the election and how will that impact the inflation and of course the market. Because as an investor, I think we always focus on whatever is happening around. Always drill down, keep our mind focused back to not on politics, but back to the market direction. So we're going to discuss a bit about the election, and then after that we're going to talk about the dollar play an important part. When we speak about dollar, I'm referring to the US dollars. Now I'm not too sure if I can do this, but later on I hope that I can engage you to ask you about what do you think about the dollar strength moving forward. Maybe I'll give you a timeline the next 2 years. That do you think that dollar from here is going to strengthen further, or is it going to weaken further? Just for you to think about, and later I'll ask you a question, maybe you can participate, and also allow me to get a sense of the market, mass market. What do you think about the dollar in the dollar strength moving forward? Then, of course, the important things that for the next 2 years, the presidential election, I think the time frame is just good. That is also good for between traders and investor. That what is our insight, or is my insight, and maybe it gel with you, and I hope that it will help you to also plan your investment and trade the next 2 years more effectively. So I also will share with you a little bit about my portfolio, what exactly am I doing right now? And inflation, as you heard what Fed say, I think their focus is on curbing inflation more than their priority is to focus on inflation, raise interest rate, than to too concerned about the slower economy. So that's their what they have in hand right now. So we're going to discuss about all these. And let me just move on to the next slide. I think that one I will not introduce too much about myself, but tonight you're going to see a lot about behavior science. Now, what do you mean by behavior science? It means that based on the events that's happening right now and what is the how does it translate to market behavior? And based on the future projection of the macro development, how would that translate to market behavior? And we're going to see quite a bit about that tonight. Now, so disclaimer is important. On my part, what presented here is not a recommendation, so please consult your licensed broker, who is Phillip Nova. And my mission is to create lateral thinking skill for every investor and traders, knowing when to take a calculated risk with market uncertainty. Today, stay with a lot of market uncertainty and a bolder risk when opportunity arises. And I think the next few weeks, I hope to take a bolder risk when opportunity arises. Now, there's a lot of uncertainty, but we will discuss throughout this whole session. And maybe about 45 minutes, I will leave the last 15 minutes for some Q&A. And I think towards the end, as I prepared this afternoon, I also want to be a little bit more engaging, whereby along the timeline, I will just maybe ask you some question. I hope that you can really participate, because it will benefit yourself, myself, and the rest of the participant, because we have, but I'm not too sure exactly how many participants we have, maybe 60. That is in a way also represent the mass market thinking, the behavior, and I think it's good to know. So at the end of it, I'm just going to give you a very simple, easy to understand, and you can apply it between how to use fundamental and technical to form ideas for long-term, mid-term, and short-term. I think you will enjoy this. And so it's not just a show, but it's really that at the end of it, the objective, I hope that I can take back something the next 1 hour, and perhaps at 8 o'clock, if you have finished your dinner, you can jump straight to the market and see how it works for you tonight. So I just want to thank you, the sponsor, which is CME, for inviting me for this topic tonight. And just a few slides about CME. I think I'm very thankful for this exchange. They have launched, I believe, is the most successful contract in the whole world, in my opinion. Now, they have launched this micro E-mini futures in 2019. And it's so timely because I think about half year later, we have COVID hit. And I can share with you that futures is one of my love. Derivative is one of my love, because I started as a floor trader in 1995, I believe it's 1995. So that was with Cymex. That's where we wear the red jacket and we're shouting for trades, all this and that. What are we guys doing there? We are trading the derivatives or futures. And can I share with you something that derivative may not bear very good light over the years, because some of them over traded. But tonight I'm going to share with you how exactly towards the end to also understand how to choose the right contract, because it's all about your own personal capacity and choosing the right amount, the risk exposure. So I would say that derivative is definitely a must, especially in time of uncertainty, where you can use it to hedge and you can use it to trade as well. So now very quickly, and what they have launched is all this micro E-mini S&P, NASDAQ, Dow Jones, and Russell, as you could see. And the volume is just outstanding. And which one is the most outstanding volume that we could see here is the NASDAQ. Yeah, but I think now maybe Dow Jones is taking over. I suspect so. Yeah, because Dow Jones related stocks and index are on the rise. Now, I just wanted to focus on the timeline, how useful futures derivative is that 2020, I'm not sure if you can see my cursor, but that's when March 2020 COVID hit. And even more that investor and traders myself, we deploy derivative to hedge and trade the market even more actively. You see how it picked up in March 2020. So every time when there's market crisis, all these derivative will pick up. Why? Because participants like myself, yourself, the institution are using them to hedge and to trade into the volatility. So this is a very interesting demonstration here that between on the left is the global market segment, and on the right is the Asia participant here. That the gray out 69% that you could see that what are this pie mean? It means that the Asia trader are very much into the technology stock, the Nasdaq, and 21% is the E-mini S&P. So later on towards the end, I think we have time. We will look at the E-mini S&P, the micro E-mini S&P, uh, um, the live market, and try to form some opinion. We'll look into different time frame from long term in the weekly chart, daily chart, and 15 minutes chart. And just to let you know that how I combine both fundamental. So the first half, we're going to talk about fundamental, and then the second half, we're going to use technical. And you can see how I gel the both together and make a lot of sense. So I hope that after the session, you can apply what you've learned and continue this explore about the market. Try to use both of them. Technical analysis is important because when we look at a chart, we're actually studying into the price behavior of what? Price behavior of the mass market, the institution play, all this and that. It all represented in all this data converted to a pictorial format. It gives us the chart. But if I'm going to give you the data, it's very difficult for us to decode what exactly is happening. So of course, the very successful launch of the micro E-mini net indices futures, CME also launched subsequently, I think less than a year later. They also launched the options, where at this moment there's S&P options and Nasdaq options available for those option traders. If you're interested, can definitely take a look at, or between these two, micro E-mini S&P options and Nasdaq. Okay, so that's the last slide for CME, and this one I would really encourage you to sign up for. It is free, and every 2 weeks I'll receive an email from them. So basically what you will be receiving is the expert analysis in helping you to turn market information into insights delivered directly to your inbox every twice a month. And this issue is very interesting because that's what I'll be talking about tonight as well. And what if moving forward, you're a bit scratching your head right now that why is there a rebound for the US market? Everyone is scratching their head, but I hope that tonight I'll just unlock some of the scratching of head moments or scratching of hair moments that what can we monitor moving forward for the next many months or the next 1 or 2 years, where I believe that the global inflation is going to persist, not just ended here, but I think it's going to persist on for the next few years. So what you should be monitoring moving forward is US CPI. It is very important data. So later on, I'm going to share with you how to study into the data as well. What should you look out for? So if you want to receive this market report every fortnight, you just do a QR code scan, and all these are just free information. Okay, so I'm just going to leave it 3 seconds before I move on to the next slides. All right, so I'm going to move on to the US election and its outcome. So what happened here is that in the US government, there are basically 3 parts to it, not just the president, but in the Congress, there's also the House of Representatives. There are 3 parties, very powerful parties, and there's also Senate as well. And what happened that when 3 of them come together, they actually pass laws. Yeah, pass bills, pass law, which is important. So 3 of them, the best scenario is that they work hand in hand together. So after that, I'll share with you why is it important as an investor that we also have to be a little bit concerned about what's happening or what's the outcome of the election. It's important to do that. Why? Now, let's look at the possible 4 outcomes. I think by now, because I prepared this about last month, by now we will know have the outcome. Yeah. So the first outcome is that president is Democrats, and of course both House of Representatives and Senate, they are both Democrats, and that's the best outcome. Why? Because they are all the same parties, and it's easy to suggest something and all agree upon and pass it together quickly. Why is it quickly? Because in the time of crisis especially, now always look at it as an investor point of view. Here is that to me, a stable government is important, that when all of them agreed in crisis management, they will have to pass something. Most of them will sing the same song together and pass it quickly, faster, that will save the market. So that is what investor we're looking for when we invest in a country. And when we invest in a country for long term, we also look at their politics. Are their politics stable or not? So later I'm going to give you a little bit more insight what's happening right now. So second outcome, of course, you could see here is the Republican and Democrats, House of Representatives and Senates with Democrats, and of course the current presidency is the Democrats. And third outcome is just a swap. So basically, so when this happened, it means that the president is going to have a little bit more negotiation between the House, the Congress, to come out with an agreement. And the worst case scenario, of course, is that the House of Representatives and Senates are both Republicans, the opposition of the Democrats. And then sometimes, because as an investor, here is that especially during crisis management is important. Agreed to all disagreement is very important because when there are too many camps, so sometimes is that politics are politics. So some of the politicians will just do politics for the sake of politicking, and that's sad, and that's the truth in many countries. So the best case scenario is one house with the same party, and as an investor, I welcome that. Why again is that because during crisis, during needed time, and it's always good to see that the whole government come together in one voice, because unity is what we're looking at for investor. Now, let's look at the situation back then in 2020, president election. Then Joe Biden became president in January, and 1 month later. Now let's look at, then this was what happened here is that president is a Democrat, and House of Representatives and Senates, they are all Democrats, and that's the most ideal situation. Now let's recap back what happened to 2020. Now, we could see that when Joe Biden became president of the United States in the date, which is 20th of January 2021, it's coming 2 years, yeah? And in between, what is the major news, events, and resistance is that inflation and high interest rate. Yeah, but we could see that between the party, Democrats, and both Democrats between House Representatives and Senates, when they come together, things are easier to move forward. Where we could see that what is the performance. Now, when the trio come together, what is the performance of Dow Jones? Based on this observation here is that, in fact, from then on 20th Jan 2021 until current, which is today, the Dow Jones is at 34,233. We could see that Dow Jones are performing exceedingly well compared to other indexes, and despite of inflation, higher interest rate. So with this combination, presidents and the two Democrats supporting, based on this logic, I think the whole market is doing well. So that's what I'm talking about. And now, so what happened here is that, is that a final outcome? I think we are not exactly sure is that a final outcome, but what I have gathered this afternoon here is that House of Representatives is Republican, and Senates are kind of, we're not exactly sure what is it right now. But the thing is that I think as time passes now, I think as investor, I think not many of us are too concerned about who win or lost. So in a short while, I'm going to give you my take about what's happening right now. Now, so important things about the election, in an investor point of view, what we should be more concerned about is that with that election result, how will that impact the market? That's important to note, right? Yeah, so now coming to this topic on the segment here is that the opportunity and threat for President Biden following the outcome of midterm election is this. Now, before the midterm election, that means before people cast their votes, is highly anticipated is that the Republican Party, the market expecting that there's a sea of rates, it means that there's a lot of overturning where you'll see a lot of Republican winning many seats, and maybe it's going to be like a landslide kind of thing. So that was what the market are expecting. And of course, with that, then we are expecting that the market will be very volatile. So volatile is not a bad idea because volatility is great for traders. So I do have two portfolio between investing for long term and trading into the short term. So you'll see the aspects later on. So that was the expectation back then. We're expecting a lot of volatility because we're seeing that the Republican will take many seats. Now, but it proved that it's not the case, which is good news for Democrats. Now, I say that though the Democrats seems to have avoided the rate wave, at one point they are talking about maybe there's a rate tsunami, so they are so confident that they're going to win many seats. But nothing that happened because Republicans still take on the House of Representatives. But the thing is that it became non-eventful. But I think as an investor point of view here is that it became so obvious right now. Even I think our Prime Minister mentioned that recently, is that the Congress, the US government, is even more divided today. So I think that's a concern for investor for long term. Now, would I want to invest my money in long term in a country where I'm not exactly sure, because when there's too many politicking in play in the house, would there be changes? If I'm going to put my money there, would there be changes? Of course, that is always the concern. And for US, I don't mind to trade them, but moving forward, but of course, it's not an overnight thing. As the time pass, as an investor, we got to keep watch very closely that how this will pan out. But my take and many other investor take here is that for US Congress or US government, that we're seeing even a greater division because, as the saying goes, united we stand, divided we fall, and that's so true in every areas, in family, in a company, in a country as well. So, and we all know that moving forward, inflation is a real threat. So how are they going to come together to manage this? So that's my concern. Now, so I will put a kind of full stop to the election thing, but I just want to bring your attention here as an investor, we're not too interested to our side, or we have a lens on which side we stand, but we're more concerned about, is the government united or are they divided? So in this case, my conclusion is that even with this election, we could sense that it's even more divided. So which is not exactly the good news. So again, how would that impact the market? And which I think I just give you my conclusion. Now, next, I'm going to move on to the more interesting topic here. And maybe I'm going to try this with you. And I'm going to ask you some questions here is that, now the topic is that with a strong dollar, can the US walk out of global inflationary crisis? Now, I think since I'm addressing in Singapore to, I believe most of the audience are from Singapore. And in Singapore, we know that the Sing dollar are very strong. And I think our government take a stand where, or maybe we're privileged or fortunate that we have strong Sing dollars. And I think the government want to preserve that, to have a strong Sing dollar in a time of uncertainty, with a time of rising inflation. Now, when your currency is strong, you have better buying power. Just think in terms of us and the neighboring country and look at the rate. If our rate is weakened, then whatever we import, we have to pay more. Yeah, so to have a strong currency, for my case, is strong Sing dollars. It kind of help the country, help the people to protect inflation or to hedge inflation or to cushion inflation. So now the strong currency is important. Now, my question here is that with a strong dollar, it is also important to help US to curb the inflation. Now, inflation is not just a US issue, it is the global issue today. So if we have time, maybe during Q&A, you can ask me about why is that this global inflation. So with time, we can discuss about that later on as well. Now, let me just move on to the next slide. Now I will ask you this question here on the chat box. I'm not too sure if I'm seeing this, but maybe Sri, if you got reply, you can just let me know that from now to 2 years later, do you think that the US dollars is going to continue to move up from here? Or do you think that US dollars is going to ease off to get a bit weaker from here? Based on what's happening around the world today, maybe you can start your before I reply, maybe I give you an answer here is that down you just put D, up you just put U. So I think Sri and myself were able to get a sense. So I could see that there's 72 of us. So my question here is that from now until maybe 2 years later, do you think that US dollars will move up from here or lower from here? So if you find that it's down, you just put D, and U, you put up. Then later on, I'm going to describe to you why is it important to take note, because with a weaker US dollars, I think the US dollars or the US itself is going to face with very hard inflation pressure. Maybe you can start to contribute your answer right now. So let me just repeat my question to you is that if you find that the US dollar is going to move up from here the next 2 years, you put U. And if the US dollar is going to move lower from here the next 2 years, you put D. Yeah, in the chat box.
Hey, Kon Hao, right now we have a couple of entries in the question box. We have a member of the audience, Mr. Tek, saying it's going down.
So maybe just wait for the next.
We have 2 for Ds and
20
2
seconds.
for
Yeah. For Sri to just gather. Yeah. I'm not seeing on my side though the chat box, so maybe I'm not enabled. But it's okay. I think it's always good to have Sri voice in the background. Okay, come. Maybe we can review the answer and roughly just to get a sense of how in percentage of the submission, how many in percentage, how many of you think that the US dollar is going to strengthen from here the next 2 years?
Okay, we have down, up, down, up, down, 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 and up. So it seems like majority is for down.
Majority is for down. Okay, why? What's the reason? And now when the US dollars is lower, now majority of down, when you say majority is, can I say it's about 60% or 70% range, your feel?
Well, 60%.
60%, right? Now, well, that's interesting here because which is good that you are noting that US dollars maybe in the next 2 years is moving down. Why is there a risk if US dollars is moving down? And it's no good for the whole world, because when US dollars is moving down, it means that it's going to a lot. So when US dollars is lower, it means that their inflation is going to continue to climb.
Hey, Conrad,
so
can you repeat the last 10 seconds? I think we lost you for a moment.
Okay, sure. So when the US dollars is weaker, be prepared that is not a good news for the whole world, because when US dollars is weaker means that, you know, they consume a lot, they import a lot. It means that their inflation is going to pick up. When their inflation is going to pick up, the Fed will have to resume its massive rate hike. Now, when the Fed say that they're going to dial down their rate hike, it doesn't mean that they're going to stop hike and minus became cut rate. It means that they're still going to up the rate. It's just that instead of moving up by 50 basis point or 75 basis point, maybe they're going to up by 25 basis point. But over the long span of period, whether is it up by 25 basis point, but if you add up for the whole year of 2023, that each meeting, if it's gone up by 25 basis point, that will still add up a lot. But with a weaker US dollars, it's going to be even worse. Yeah, because inflation is going to pick up from there. Now, let me just explain a little bit more in depth about the US dollars, and what you should be looking at basically are 2 things moving forward: the strength of the US dollars and as well as the CPI. Now, let's do a recap what happening over the past few days. Is that on the 10th of November, we have the October CPI that came out, it came out at 7.7%, and it is just about 0.5% lower than expectation, and that caused the Dow Jones to have a huge rally, about 1,200 points. And this day itself, the 10 November, it rally 1,200 points. It was the largest rally over the last 2 years, or one single day. Okay, now, so what you're seeing here is that just maybe people have a wrong idea that 7.7 is lower than expectation, that, oh, it's good enough, they ram up the prices. But let me just share with you what happened. The risk here is this. Now, remember, 7.7% is the October CPI number. Now, the next one, I will need you to do some exercise here. I want you to look at the blue line. Now, blue line is the inflation of US over the last 40 years. The last 40 years. Now, what's the difference between blue and red? Blue, it represents it include oil and food, which is important. Okay, so we cannot exclude oil and food when you talk about inflation. Now, I want you to look at the blue line that I highlight in pink zone during that period before the inflation started to pick up at the middle of 2021. Now, look at over the last 40 years, since 1982 to 2020, that period. Now, I want you to focus on the blue line. Can you give me the average range of that blue line over the last 40 years? Now, I want you to develop a sense here is that I'm not too sure if you can see my cursor. This is 2.5. So average, especially after 1990, what is the average top side range of this blue line? Where did it stay under? Okay, now take some time to study through this. Maybe I'll just give you about 15 seconds or 20 seconds. So later on I'm going to review the answer to you. Okay, now focus on the blue line to see what was the average upper band of the inflation numbers over the last 40 years. Okay, so it's about 3%. Okay, if you look at especially after 1990, most of the time it stay below 3%. And 3%, it will be good for inflation, or I mean, of course, the world is printing money, not just the United States. So when you print money, naturally you'll cause a dilution of currency and inflation will pick up. But I think over the last 40 years, most of the central bank have managed very well. They try to cap inflation at about 3% on the upper band, right? So the latest number at 7.7%, to me, is still like double the size of the 3%. Still, to me, it's still not good. We're not out of a danger zone at all. So I want you to be mindful about that. It's just that over the last, if you could see November 2021, the orange zone is the first time, that was November last year. For the first time, it broke the 30 years high. And February this year, it broke the last 40 years high. It just, if you look at the month to month from Feb all the way to August, it keep on staying on top of 8%. So what happened to October? It was like taking a breather, that finally the inflation it didn't go above 9. Not like the UK. I think UK 2 weeks ago we saw that inflation was at 11.1%. It was great. So market just brought some relief to the market, but that doesn't mean that the inflation is over. It's far from over. Okay, so this is something that I have to let you take note. And of course, then the next question is that, then why is the Dow Jones picking up in such a manner? So we're going to discuss that shortly. But I just want to let you know that at 7.7%, inflation is far from over. It has to come down to below 5.7. Yeah, the top side of this in 1990, the top is about 5.7. You have to come down below that. Then I would say that things are easing off. And then the next step for the Fed is that they still have to bring it down to below 3%. Is a stressful job for them. Okay, so that's all about CPI. And two things that you have to take note moving forward. The most important thing is not just election. The most important thing is CPI and the US dollars. Okay, these two you have to take note, because CPI start to pick up. Be prepared for more inflation, or be prepared for more massive rate hike. And if US dollars weaken, it will take some time. There's delay. US dollars weaken, also be prepared that inflation will creep back up again in US. Yeah, so that's something that you have to know. Now, so I have a forum that on the last day of September, so on the 3rd of October, we discussed about the dollar index. So we are quite sharp, we're quite on spot on for this dollar index, and we could see that that was an inverted hammer. So I'm suggesting that technically, US dollars should be coming down, but of course, within our discussion, the forum, we also talk about fundamental. So it kind of gel together. So towards the end, I'll showcase some of the how we understand the fundamental and technical, how we can gel together, and you'll see the wide spectrum between long-term, mid-term, and short-term trading, how we can gel fundamental and technical together. Now, so the dollar index, what we saw then back then on the first few days of October is that we are expecting the dollar index to come down. So is it true here? So dollar index has been coming off over the last 2 months, and today is lower, it's about 105 region. Now, so with a strong US dollars, which I'm quite glad that about 60% when I ask you this question that you perceive that maybe from now till about 2 years later, the US dollars will weaken. And now we maybe understand, we have some understanding here is that US dollars weaken is not a good news for inflation. When US dollars weaken, it means that inflation will continue to pick up. If you find it's difficult to understand, just look at between Singapore and our neighboring country. When you go holiday and the exchange rate, then you will get a better understanding why a strong currency is important in the time of inflation. And weak currency is not a good news at all. Now, so I think 60% of us agree that US dollars will have some headwind, and if they are strong, that's good news for them. But if the US dollars is weakening, and that is bad news for them, and is also not a good news for many of us as well. Okay, so yeah. Now, let me just share with you what happened here to a weaker dollar based on what's happening recently is that US dialed down their interest rate hike. Why? Because their CPI is lower than expectation, just for once. Okay, so for that reason, market participants are saying that perhaps the next rate hike will be maybe 25 or 50 basis point instead of a massive rate hike at 75 basis point. Now, the next one is the optimism in China and Europe. And China, of course, I think I don't have to explain too much. They are gradually opening up. And Europe is that their winter this time round, it seems like it's not as cold as they thought. So it's warmer winter that they have. It means that between China and Europe, business is as usual. So in that context, investors would like to flow their money, their investment to China and Europe. So it's not just in US. So of course, fund flow, money flow, going to one country, then the other country will be a bit lower as well. So that could be one of the reasons. And then the other reason, it could be the start of Europe massive rate hike. So what we could see here is that European, for the first time, I think for the last meeting, 2 meetings that they have, they also hiked 75 basis point for the last 2 rounds. And UK, for the first time, the latest one, they also hiked 75 basis points. So basically, if the other country's central bank also hike their interest rate, it means that their bank will also offer better fixed D rate as well. So investor will naturally say, well, okay, so I will put my money in your bank because I'm going to earn, or your currency because I will able to earn more better returns in, say, for example, fixed D. So the other one could be the sanction effect. The sanction effect means that because of all the sanctions that taken place over the last 2 years, especially, some countries are start to have alternative in how they're going to deal with their trades. So it could be that as well. So I think there are reasons why fundamentally you could see that, right? Just now we look at the technical reason with an inverted hammer, but the fundamental reason we got to match up with it. So once there's a match between the fundamental and technical, then I can tell that being a trader or investor, we will act with greater confidence. Okay, so we're going to move a little bit deeper into it, how I apply that. Now, so I have this YouTube channel called Invest and Trade with Insight. So what I've just spoken about, some of it or many of it, I have produced some short little snippets of videos. You can go and visit them to understand better. If you find that what I've just spoken about is really interesting, and basically the presentation I have is always I try to gear towards knowing the fundamental and time it with technical. So when you can combine the two together, personally, I feel that there is like a confidence that I should go for it. But of course, in every engagement of trade or investment, there must be always a measured risk. Measured risk means that you always must plan for the worst case scenario. What if it did not come to pass? So what's my risk management? So that's important. Now let's look at the next topic about the US market and its direction before the presidential election in 2024. That's next 2 years. Now, so what is the my take? So again, it really depends on the inflationary data. So I want you to focus for, of course, this topic was given to me about 2 years ago about the midterm election. How would that impact the market? But I think at this point in time, I think the Malaysia inflation, I think the focus is more on there than on the US right now. So I think hardly any investor are looking at what's happening to the US election. But moving forward for the next 2 years, please take note of, if you could, every month just schedule in your handphone, set an alarm that the CPI number, when is it going to release, track the CPI number, and also for the time being, continue to track the US dollars. Okay, so I hope that would be helpful. So you give us a sense that whether the inflationary pressure is still so tight. Yeah, so if it's still tight, you just have to prepare that interest rate hike will be continuous. Yeah. So yes, so how you can get hold of all this data, you can just go to this source, FRED, you can get hold of all this data. So all these are free data available. Okay, oops, just give me a moment. Okay, so what we have shared in February 2022, now I'm moving to technical. So later on, you're going to see that how I apply the fundamental. I think we spoke a lot about the fundamental, the macro development. Now I'm going to share with you a little bit of an insight about how to use technical. Then in about a few minutes time, we're going to look at the live chart. We're going to look at the weekly chart to get a sense of where is the long-term perspective, the daily chart, the midterm perspective, and also the 50 minutes chart for those traders who like to trade intraday or a position, maybe a 1 or 2 days position trade. Yeah, I think you'll find interesting that we're going to combine the fundamental and technical together. And I'm going to share with you a very simple strategy, how you can, on your own end, you can derive a view very quickly. Okay, yeah, so this is how it works. Now, first of all, what we share in February this year is that we share on this uptrend. So basically, we recognize that inflation is real, is picking up. Yeah, and now how to draw uptrend basically is that we have to find at least 3 significant trough. Now we saw there's a lot of significant trough, and if we join all the dots together, the number 2 rules is that I say that after you find at least 3 significant trough, we try to find the best fit. That means we fit all of them together. And if we could fit all of them together, it means that this uptrend line is very good. It's very solid. But there's always a but, right? But if this uptrend line is being compromised, means that it's broken, then it is also going to be very serious as well. Okay, it means that there's a turnaround. So what we have discussed here in February was that we saw this very beautiful uptrend line. So we also discussed about the inflation. Back then it was 7%. And on the 3rd week of 2022, or the 3rd week of January, so basically the same thing here, is that we saw that this line, it broke down convincingly this uptrend. It broke. Then at that point in time, on the 3rd week of 2022, I am prepared that 2022 is going to be a very challenging year, and there's a transition from a bull to the bear market. So basically the whole idea is that once you understand the fundamental, look at the technical for precision timing. Okay, so you need the technical for timing is important. Now, so then my plan was that as it move up, so this is what happened now. Okay, so as it moved down, I'm prepared to trade the US market. So it gives me a lot of trading opportunity. So basically just move up and down. So on the third week of 2022, we acknowledged that there is a transition between the bull and the bear, and not forgetting the fundamental proposition that we're in early as well, that we recognize that the inflation, even back then, we already understood that inflation is going to be continuously very stubborn. So our mode has been, instead of buying on dips before 2022, but in 2022 it was, or it is still sell on strength. So notice my grammar, I say that it is still a sell on strength, and this was prepared in October. But even today for NASDAQ, I even looking out for sell on strength. So basically, what is the US stand in the US market here is that from now until 2022, I'm going to look so close like a hawk, the CPI number. If the CPI is still maintained at about 6% and above, we are not out of any clearance at all, especially 5.6, 5.7, but I will not get into detail why 5.6, 5.7. If it's 6, 6.5, it is still not good enough because the last 40 years, just now I explained that we have looked into that. I'm just going to very quickly move on because I'm going to spend a bit of more time for Q&A if we allow me to do that. So basically is that till then, from now till then, the next 2 years, what should investor and traders do? And I'm going to share with you my portfolio. And basically what I'm currently doing is that for the US market, I'm just interested to trade them. Trade them means that weaving in and out, as you could see earlier. Let me just go back to this chart here. That since the transition of 2022, because it broke this downtrend line, so basically it offered quite a bit of trading opportunity in the US market even today. Okay, so basically I'm more geared towards sell on strength for the US market, especially the NASDAQ and S&P. So Dow Jones, I'm not going to touch it for a while, but especially on the NASDAQ and S&P. Now, and for the Asian market, so basically when US market continue to move down, say for example, Asian market will not be spared as well. It's just that our downside move may be a little bit limited. So I do not mind to gradually accumulate them for as an investor, but commodities I will buy them. So in January with Phillip Nova, I think I'm coming back to share on the commodities. So do mark your calendar that I'm going to share with you what I mean by to buy them in the commodities and what type of commodities should we be looking out for. Now, so very quickly, I'm just going to look at how to trade the US market. And let's apply this trend line I just shared on this live chart that I have. And right now, I'm going to share with you on micro E-mini. So basically, before you trade anything, you have to know what are you trading. So basically, micro E-mini S&P is a very light contract, which I enjoy trading a lot. So it states that every quarter point is $1.25 US dollars. So it's difficult to equate. So I took the liberty to convert it to 1 full point. So 1 full point is 5 US dollars. So you just have to remember 1 full point is 5 US dollars. Now, this is what we're going to do here. And I'm going to look at the S&P to give us a sense where is the direction moving forward. Now, you still remember about earlier I mentioned about to connect at least 3 significant troughs, but in this case will be 3 significant peaks because this is a downtrend still. Now, so this is what I'm going to do, and we are looking at the E-mini S&P futures, and of course there's a little brother which is 10 times size smaller. It's called the micro S&P. Now I'm going to connect these few dots together. Now, remember just now I said that at least 3 significant peaks. Then after that, I try to find the best fit. And this is what I mean. And I found that the on the weekly perspective, that the S&P is still behaving very nicely on this downtrend line. And what's my expectation for S&P? Now, why the downtrend line is important? Because it helps me to, it gives me a path So once it close to here, I'll be a bit concerned that I'm going to keep a little bit closer watch, see how well it's behaving. And I hope that you'll break though. Yeah, so break, then my strategy will change a little bit. So for the time being, I'm still a little bit bearish on the S&P and NASDAQ. Now let's look at the daily chart. So this is a weekly chart for S&P. As we are moving into daily chart, we're going to apply the same principle. Now you could see that this weekly chart downtrend line is still there. So the target could be somewhere around here. Now on the daily perspective, what we're seeing here is this. Let me just connect the dots. You've got to find at least 3 significant trough. Now, so this is how you can do it. And you try to find the best fit. So along the way is about doing a bit of research and analysis. And I just felt that you've got to see the behavior of the market, how well it reacts. So we have to make adjustment, do this what I call research into the market. Now, as I make adjustment, I noticed that the daily chart, this low has been reacting very well. This low, this low, this low, this low. So there's 4 lows, 4 significant lows. And what doesn't matter here is that if I'm going to do some position trading, so that's what I'm seeing here on the daily perspective, I'll be still keen buyer, but I have to take note that on the weekly perspective, in time to come, maybe this could be a real resistance. So you see how that I'm very cautious on buying because the inflation threat is not over yet. So you see how I trade, how I invest, a little bit more cautious on how to buy. And once it reach a certain target, I will not be too greedy to take out partial or all of it if it's reacting very well to this weekly trend line. Okay. Now I'm going to move on to 15 minutes and let's see how it works here. Okay, so 15 minutes and just apply what we've learned and see whether if you're into intraday trading or short-term position, and how will this trend line help you. Yeah, so basically I'm going to find a dot first. Yeah, you just have to go ahead to find a dot, then you try to connect them together and you try to find the best fit. That's what I mean by finding the best fit. I'm going to expand this a little bit. So on the 15 minutes chart, I think it's still on buy on dips. If you could see that it's behaving pretty well to this trend line. Now notice that how I draw a trend line is that the rules are you have to find at least 3 significant trough, then you do the best fit. The second rule is this. And I would say that this on a 15 minutes chart perspective is behaving quite nicely. Yeah, it's touching really solid point, and this rested at the neckline around here. So along the timeline, if I'm going to trade very short term, I'll be mindful about this trend line. Maybe perhaps that if there were some support here, I may be looking to buy just for doing really, really short-term trades. Yeah, something like this. Yeah, but if it break, then I just got to be very mindful that how will be the daily chart transform into, what's the picture like. And of course, the broader picture in the weekly chart, you have to be mindful about inflation threat is still there. Will that from gradual from smaller time frame transcend to a larger time frame from fundamental to technical development? So if it does, then it kind of give me a better information that maybe the trend have again start to change again. All right, so now, and I think I'm just going to stay here for a little while. Here is that earlier what we understand is that, let me just go back to this slide again. What we mean by safe trading here is that 1 point is $5 US. That's what I mentioned here for S&P. And we could see that it's possible from 40-40 to about 40-50, 10 points. So 10 points, what's the worth? And you can equate it for yourself for those that are into intraday. But do take note that every trade that you do, as long as I trade the market, I have this notion that I'm trading the market, I always have a risk management. Means that in the event that I'm wrong, where can I cut loss and how much is it going to cost me? So all this has been already been calculated. So again, my tip for you is that as long as you know that you're trading, so please have a risk management. Means that before you get in, you also have to know when to get out if you are wrong. Then how much will that going to cost you? Okay, so and yeah, so this is what I've just prepared for you in case my live charting system kind of get a bit hang up. So this is what we have discussed. And before I go into Q&A, I have this Facebook page. Just go ahead to like or follow it. So every day I will post a market insight based on what I understand of the market. So if you enjoy the flow for today's presentation, be surprised what I'll be posting tomorrow about a new market insight. So the YouTube channel that I have is called Invest and Trade with Insight. You can go and visit them as well. So I post a lot of 10 to 13 minutes video to just to it's an interest. I enjoy doing that. So of course I also need an audience. So if you find that what I presented here is interesting, just go ahead to as the time passes, I think the library has just built up tremendously. So lastly, that's my email, konhao@weipedia.com. So if you find that what I share is interesting, you can always drop me an email. So I'll just turn this time to maybe Sri again. Yeah, sorry for getting too excited. I think I've just take out quite a bit of time. So.
Not to worry, Konhao. Good content is always welcome. Meanwhile, members of the audience, based on what Konhao has walked us through today, if you have any questions, you just head down to the question box, which is located on the bottom area of your control panel, and type your questions in there. We will have send them Konhao's way, and he will give you his insights to your queries. Konhao, you should be able to see the questions panel now. If you rather address them, you can, but we don't have the questions in there yet. So let's just give it a few minutes for the questions to come in. In the meantime, Konhao, based on what you have shared today, what will be your three key takeaways for the audience?
Okay, my key takeaway for the audience is that I think most of us, again, are scratching our head why the Dow Jones have rallied a lot. But you may also want to take a look at the Nasdaq and S&P as well. I think the traditional stocks have rallied a lot because I think when markets uncertain, people will still go back to safe, good old stocks. So that's what's happening right now. And the more vibrant stocks are still very much hammered down and still staying under for at least down 20%, some of them even more. So definitely we're not clear off the woods yet. So what you should be looking at is that, again, please every month monitor the CPI number. Even 6%, it is still not good enough. Okay, so yeah, so monitor the CPI especially. Then also briefly take a look at what's happening to the US dollars. Yes, these are the two things that you I constantly every month I'll be looking at that. Okay, I will time it, look at it, and try to understand what's happening. But I can tell that even the central bank, they themselves are looking at it very, very closely. They are also very nervous. This is what when I attend a few dialogue sessions in Singapore, that's what I gather as well. Nobody knows. Nobody will have the answer when will be the next CPI going to be like. Nobody knows. But as of now, the sense that I gather is that inflation pressure is still out there. Maybe US just take a brief retracement, but if you're going to look at Europe and UK, it is still very bad. It's not over yet. So, okay.
All right, we have some questions coming in. First one is from Francis. He's asking, how much stop loss should I take for each trade? Or is there a method you typically use with regards to setting a stop loss, Konhao?
Yeah, so Francis, I think definitely you are a trader. So I think very important thing is that you don't focus on how much stop loss you should take, but rather I will recommend you a strategy whereby you work backwards. Now, what do you mean by you work backwards is that you, first of all, you have to understand how much in dollar value that you can stomach in each trade. In the event that you lost, how much are you comfortable to lose? Is it $50, $100, $200? Your neighbor may be comfortable to lose that $2,000 US. Yeah, because his net worth may be different. But you got to ask yourself, how much is it? You have to define that. So once you're able to define that, then like what I say, you go and select that contract. If it's, let's say for example, is your risk appetite is just about $200 US per trade, no more than that, then I think micro, E-mini, S&P, Dow Jones, Nasdaq is definitely suitable for you. The size is just right. So know where to enter and know when you are wrong. Yeah, and then you just know the difference, and then you look backwards. What I mean by backwards, backwards of your own personal capacity. Because if you define that $200 US is the maximum loss each trade, then be that way. Yeah, so try to work backwards. Yeah.
All right, next question is from Dave. Dave is asking, what is your strategy for identifying whether the S&P 500 has reversed its trend?
I think just now I draw a few trend line. Let me just go back to
Yes, thank you, Konha.
yeah, maybe I just go back to this monthly chart. Maybe we look at the weekly chart perspective. Yeah. I think that make more sense that in the next few weeks, next few months, if you still remember this session, you can track back. But if you're going to share about 15 minutes, maybe tonight, tomorrow will be over. So now, so what I'm expecting here is that if it behave very nicely, so even that the market start to move up, break above, yeah, I try my best to do that. I do not know how I can do this, but let's say, okay, this is the first time I'm doing this. Okay, so sorry, it's not a perfect inverted hammer, but I think you know that I'm trying my best. Yeah. Okay. Anyway, it looks more like a musical note to me. But let's say this is inverted hammer, means that along the timeline, say for example, it broke all the way up to about 4,002, and at the week, by the week close, it kind of come back down and close here. So when we look at the market itself, it's still behaving very nicely to this trend line. So I'm just giving an example that if that happened, then I know that although it broke this downtrend line, I think that we're still quite on good track, that I will continue to reference to the other siblings of S&P, the Dow Jones and Nasdaq. If they are also having a similar behavior, then that will definitely increase my confidence to get into the market. But mindful about that, the fundamental is still there, where we discuss, I think we spend reasonable amount of time, the whole evening, about at least more than half the time, talking about inflation. Yeah, so the inflation pressure, if it's still there, is still hanging at about 7, 8, 9, then I think the likely scenario will happen. Yeah. Thank you.
All right, the next question is from Daniel. Daniel is asking, in terms of technical analysis, is it true that the larger the time frame, the stronger or more certain the trend? Like, or maybe, how do you know when you should stick with the current time frame or go to a larger time frame?
Okay, so if you follow my this just now the practical session, in fact, I look at all time frames, that you notice that as I look at a weekly chart, you'll give me a perspective that is still the major trend is still downtrend, but on the daily and 15 minutes perspective, it still is at the moment uptrend. But be mindful about the weekly perspective. So it's important to have a few time frame to form an opinion. I think just now was a very good exercise where just a very simple trend line being drawn with understanding of fundamental and looking at just between 3 time frame, weekly, daily, and 50 minutes, you're able to form an opinion very quickly. And as of what time frame to use, to me, I use widely even the yearly time frame. Now, so if you can, why a commodity is a buy, go and look at the yearly chart of most of the commodity product. Yes, so I even looking at the yearly chart. Yearly chart means that one candle or one bar itself represents one whole entire year. I think when we do research is free. The only thing that's not free is our time, but I think to me is interest, is something that I really enjoy doing. So just be free to use all these resources. Be bold to explore into different time frame because it will give you a different perspective. But when you look at the market, so please look at the contract that is with liquidity, okay? And the contract that's liquidity are the few that we have discussed tonight. So all these are, if you notice that the first few slides that I show you, liquidity to me is important because then I can access to quality data, because every data being posted, they are of good standard because it's not gappy, it's being transacted. Yeah. So with that, I think thank you, Sri, for the good question there.
All right. Do we have time for one more, Konhao?
Maybe the last one. Yeah.
Yeah. All right. Dave is asking, besides stop loss, can you hedge an instrument like S&P 500 versus QQQ to reduce your risk?
Sorry, the question again.
Besides stop loss, can you use some other instrument like S&P 500 versus QQQ? I believe that's a product code to reduce your risk. So it's trading to products. Yeah.
Okay, I think this question is unique and is good for the individual to ask because first of all, personally, I don't hedge too much into it. Between countries and nation, I do hedge. Yeah, so that's why you see my mandate is that I trade the US, I accumulate into Asia, right? So that's a form of hedging. But on the specific question on QQQ, because I myself, I do not use that as a hedge, so I don't have an answer to you. But if you find that it makes sense to you, go ahead. Yeah. So to me, I don't have an answer to your question because I personally I do not apply between the two contracts. Yes, if you find that there's a good ground that it can be a good hedge or good trade between risk management between two markets, go ahead. Make sure you know what you're doing. Say, for example, again, is that I trade the US market. I used to invest in US, but since 2022 this year, in February, the third week of Jan, I try to clear as much as possible. But I've been getting into the Asia market, but I'm trading heavy on the US market because just to sum it up, I think volatility is great. Volatility is great for traders because just now we could see on the daily chart, 15 minutes, there was volatility. So we love volatility, but investor, we do not like volatility because what we invested here today, it may make us some money, but because of some unforeseen circumstances, it is so volatile. Whatever we've made, we have the paper profit, you have eat up into it. So investor, we do not like volatility. So investor, I look for main trend, the big trend, and I think the big trend is in commodity moving forward. Not happening yet, but I think we should be prepared for that. That's my personal take. And definitely in the US market, I enjoy trading very much at this point in time. Every day, every week, every month, there's surprises. There are volatility. So last take for you is that, so if you want to trade, choose the right contract size for yourself. I do not know who you are, but you know exactly who you are. And then, yeah, so choose the right contract size is very important. I lost my train of thought. What's my second point? But in anyway, thanks for staying through for the last 1 hour, 10 minutes. I think it's been a pleasure to be back with Phillip Nova again. Yeah, thank you.
All right, thank you so much once again for being a wonderful audience, and thank you once again, Konhao, for your valuable insights.
Thank you.
And members of the audience, if you still have questions, you can send your questions via the survey form at the end, and I'll reach out to Konhao tomorrow, and hopefully he can provide short responses to you in our follow-up email. All right, thank you once again for being a wonderful audience. Take care, good night, and stay safe. Bye-bye.